Well, it's a very good morning from me. I hope everybody's well. New starter there hasn't got me on the stall, you see, that's what it is. So kind of caught me out a little bit. So let's go on air and welcome you to our live stream here on Monday morning, middle-ish of October. We're having a lovely bit of weather here. We popped up to the Scottish borders at the weekend to see my daughter Jess run a marathon. A place called Kielder Forest. Fantastic place, just like phenomenal. You know, it was just lovely and sunny. Lots of midges around though, everywhere. Just time of the year, I suppose. Anyway, hope you're well. Hope all is good with you in your world of mortgage advising or financial advising, whatever is your chosen route. We've got a couple of topics for you today. We're going to be updating you on mortgage market, really. A lot of people are asking me about how things are changing and the CMAP syllabus. We want to update some of the videos there on the mortgage market and how mortgages are lent and the UK residential marketplace for the current decade, really. So we've got a couple of updates for you. You may learn something, you may not. It doesn't matter. You might just update yourself and get a few new ideas about how things are moving forward, which is obviously the key to the whole thing, isn't it? So I'm going to head over to that whiteboard to start with. Then I'm going to go over to that whiteboard to finish off with our session this morning. And if you're on the live stream, of course, you'll be able to see the visuals. But if you're on the podcast, you'll be able to listen and hear me talking through the situation. So let's head over to the whiteboard over here then, because what I want to do now is to talk to you. What I want to do now is talk to you about the residential mortgage market 1980 to 2025, which you may be in when you're watching this video, you may not be, it doesn't matter. Now, I'm fortunate enough to have been involved in the mortgage market in 1980. I don't look old enough, thank you. I don't know if anyone agree with that or not, but anyway, the fact is that I started working in a building society actually at the tender age of 16, as I was part-time. I was sixth form, and so on a Saturday morning I worked in a building society, and of course I then started my career and then moved onwards. So in 1980 then we've got a situation where on the board here I've got three types of occupation. Residential mortgage market 80 to 25. I've got 1980, 1990, 2000, 2010, 2020. I'm just going to talk you through what kind of happened in those periods. Now here we've got owner occupation. Now this is the British person's dream, if you like, to own their own bricks and mortar, owner occupation. Then you've got private renting. This, of course, is people renting from private landlords. And then you've got social housing, which is people renting from housing associations or the local authority. Now, way back in 1980, the percentages were quite interesting, actually. And I'll just put them up for you. And I've researched these from UK government statistics. They're pretty up to date. But in 1980, the percentages were the following. Owner occupation was around about 56%. Let's sneak that in there for you. In other words, 56% of people owned their own houses, so just over half, which wasn't too shabby, really. The bulk of it, though, was social housing. Social housing's down here, and the number there for those guys was 32%. Private renting was minimal back then, and the numbers there were 12%. Let's just stick that in there for you so you can see that. So as you can appreciate, that is up to 100. Most people own their own property. I get all of that. But of course, social housing was a third. And I lived in a council house myself with my parents. And it was an enormous number of estates built after the Second World War, particularly, where people just rented from the local authority. How cool was that? They were good houses as well. Now, the mortgage market in 1980 was not regulated, but it was all siloed off. And people, or lenders, I should say, pretty much did their own thing. Building societies lent on mortgages. That's pretty much the only place you could go to for a loan. And those days you had to queue up for quotas. You had to queue up to get on the list, if you like. There was no intermediaries or brokers or anything like that. It was all branch based in those days, of course. Now you had this thing called deregulation came around. In around about the 80s, Maggie Thatcher came in. Deregulation meant that banks could rain on the parade of building societies, and other institutions could lend money on mortgages. Insurance companies got involved as well, which opened up the market, which made it very competitive. What you also had back then was this little thing called MIRAS, which was tax relief on your mortgage. which is great, isn't it? That's tax free on mortgage interest. People don't appreciate that nowadays. At the highest rate as well, obviously, Myris was reduced and withdrawn just before the turn of the century, but it was reduced. But it was great because it encouraged people to buy. What you also had there was pretty big, was what they called the right to buy. So down here on the social housing in 1980, you had the right to buy. Now, the right to buy was legislation introduced by the Conservative government at the time, which allowed council renters like my mum and dad to buy their council house at a good discount too. And of course, it gave the building societies and the banks, who are lending a little bit now as well, the ability to lend so much more money. And the whole mortgage market therefore took off. Owner occupation then surged. If I go forward to 2000, just to give you some ideas on this one, in 2000 the numbers surged, just stick that for you, to 71%. Can you see that? 56 to 71%. The owner occupation surged. So you can see all these council house buyers bought their house. In fact, if you look at the numbers then for 2000, I've got the social housing one there as well. Got that written down, 19%. So that's gone down to 19%. And the other one, of course, that started to really improve itself was private renting. And that came in around about the same sort of figure, really. That came in about sort of 10%. So you can do your numbers there, can't you? Private renting, of course, 12% to 10%, pretty much the same as it was. It's the social housing that went down, and owner occupation surged forward as well. So the right to buy was great. It allowed more people to buy their properties. The mortgage market started to bubble nicely. But towards the end of the 1980s, early 1990s, you had the property crash. Now, people don't remember this much, but we had a terrible crash and we had negative equity. There you go, let's put in there negative equity. What happened is the housing bubble, if you like, burst in around 88, 89, and house prices in nominal terms started to plunge dramatically, particularly in the southeast. In real terms, of course, house prices fell because that's with inflation, but in nominal terms, they fell dramatically, and we had a huge issues around then as well. Now, the property crash occurred. It didn't pick up until the late 90s. In fact, property in the 1990s did disastrously badly, and over the whole 10 years. People think house prices are going down now, but back then they really plummeted. But you had a bit of a boom in the late 90s into the early noughties. The Labour government were doing really well. You had a bit of a boom started to occur then in the owner occupation market, in the private sector, if you like. And people would buy the houses. House prices started to surge quite dramatically. You had things like the subprime mortgage became popular. So more and more people could borrow. We had intermediaries come into their own, of course, specialist lenders doing their lending. Specialist lenders kicked off in the 80s, but they started to become more and more popular in the noughties as well. And of course, the provision of mortgage finance and owner occupation goes together, obviously. Most people who buy a house have a mortgage, and of course, they've paid the mortgage off or they've inherited it, which is rather nice, isn't that? So, up until about 2007, 2008, things were looking really good until you had the crash. So, I'll put that in there for you. You had the financial crash, the credit crunch, as we now know it, in 2008, 2009. Actually, it crippled into 10, 11, 12, the credit crunch, because lenders stopped lending. Specialist lenders went out of the marketplace, and it was only the banks who were lending. They were lending Bank of England money anyway, which is terrible. And of course, interest rates then started to fall dramatically. So there's your percentage interest rates, and the bank base rate hovered around the sort of 0.5% mark for much of the decade, as we're very well aware of at the moment. Now, at that point, you had the rise of the mortgage broker again. Mortgage brokers did okay in the late 90s, mid noughties, up to about the crash. Mortgage brokers, mortgage intermediaries did really well. They lent a lot of money to the lenders, but they just died overnight, literally at the crash. They started to come back again in the sort of 2012, 2013 mark. And of course, we are where we are now with mortgage intermediaries. Of course, we had the pandemic. Let's zip that in there for you. The pandemic in 2020. Interest rates went even lower, and we had the stamp duty changes. The government's been tweaking stamp duty for years and always will do, and it affects the mortgage market. Of course, we've now got interest rates going back up. There we go, to levels most generations haven't seen. I have, I've seen 16% here in the crash, 91, 92. Interest rates, of course, came down then, but of course they're going back up now to around sort of 5% mark, 6% mark bank base rate. So you've got a situation now where things have meandered in the owner-occupation marketplace, but now we've got some different percentages. So I'll put these up in red for you so you can see these clearly. The percentage of owner-occupation, etc., has plummeted. I suppose let's put it in blue again, the same colour. And the numbers, just to give you the right figures for you, have come down to 64% now for owner-occupation. So as you can see, owner occupation started at 56, rocketed to 71. That's the highest it's ever been. Now back down to 64%. And of course, who's won over on that one? Which sector has benefited? Well, it's the private renting sector. Private renting's here from 10%. It's now gone up to 19%. Let's get the right figures for you. 19. And we'll talk about that in a second. The social housing at 19% there has pretty much stayed the same, really. It's gone down to about 17%. Most council houses that were bought in the 80s and 90s were bought and paid for. Many then got to the stage where they couldn't buy. And of course, housing associations now have the right to buy, the right to acquire, but very few people do now. And as you can see, the amount of social housing has gone down. But the winner, of course, is the private housing market, private renting. It's gone from 10% in 2000. It's doubled in 20 years. Now, you may be aware of this, of course, if you're in the mortgage marketplace. Private renting has always been available, way up. For hundreds of years, people have rented privately. But the thing that made the difference in 1980, let's just put the detail over here for you, in 1980s, was the assured short hold tenancy. Not a lot of people know that, but your 6-month short hold tenancy legislation was brought in the 80s. And that allowed a landlord, she could buy a property and then she could rent it out to a nice tenant for a 6-month period and then kick them out after 6 months. It made landlords more able to rent happily and have a flexible business. Because prior to that, you had lifetime tenancy, so you couldn't get rid of people, unless you illegally kick them out. And that changed everything. Lenders started to do buy-to-let mortgages in the 90s. So the buy-to-let mortgage that we know and love now only really started to become popular from lenders in the mid-90s when the market started to improve. And there, of course, they worked out interest ratios or rental coverage in order to let the landlord borrow the money on private. And that changed dramatically. In the 2000s, things, of course, increased until the crash, and everything died in the crash in the private renting market. After about 2012 onward, the private rental market has accelerated because of the benefits. Now, the Chancellor of the Exchequer in the Conservative time, about 2016, decided to change the tax regime for buy-to-let landlords, and that's when you had the demise of tax benefits. So you had the buy-to-let tax changes. Here we are. Just put that in there for you. George Osborne, it was. There you are. He's now doing all right for himself as George, but he changed the way that a landlord gets her tax relief on mortgages for private rental. And every year since then, more and more changes have come into the tax regime. And now, of course, we've got interest rates going up, which affects buy-to-let mortgages. So coverage is very difficult and affordability is becoming very, very difficult. They've got new legislation coming and requiring them to upgrade properties to be more energy efficient. So we might find the 19% might come down a bit at some point in the future. What will replace them? Possibly owner occupation, maybe more first-time buyers who are renting. Because that's the difference, isn't it? People are privately renting where they never did, and the owner occupation was gone down. So you just do the numbers, can't you? So if we could maybe move some of those into their own owner occupation, some of the younger generation coming through to buy their own properties, that may be the way the market's going. Personally, I'd like to see social housing having a resurgence. I think there's definitely a marketplace for social housing. Back in the 70s, 1980, 32% of people rented from the local authority. And it was a good property, well constructed, looked after, fair rent. Everything was fine. I'll leave you with a final statistic. Don't know the numbers, but more anecdotal, really. And I could dig out the numbers for you. But from the right to buy, which allowed people to buy their council houses, there's quite a lot of council houses that were bought that are now privately rented. So what's happened is that whoever owned the property bought it from the council and then sold and moved on, and they sold it to a landlord who now privately rents that same house. So it's a massive proportion of ex-local authority properties rented privately. Personally, that's wrong, but there we go. That's my sort of personal views coming through for you on that one. So that's been a lovely little summary for you of the residential mortgage market in the UK up until about the sort of 23, 24, 25 mark. Hope that's been interesting for you. Bye. Great work. Okay. Hope you enjoyed that. That's a nice little update for you on the UK residential kind of situation, really, and how things pan out. Let's just pop across to this camera now. So what I'd like to do now is to add to that a little bit, really, and take a look at this topic, which is the UK lending sector. In the mid 2020s, and obviously it's been recorded in 2023, you may be watching this video a little bit later. But where does the lending market sit now? Who's lending the money and who's organising all the lending is the question to ask you. So let's take a look at who's who then in the marketplace at the moment. Who's lending money for mortgage purposes? Well, you've got the old guard, if you like. You've got the banks. Let's pop those over here for you so you can see those clearly on the thing. You've got the banks, of course, are lending quite happily. Always have done, well, since the 1980s, and always will do. And banks are lending well. They've got their own employees. They lend via the intermediary marketplace, of course. They use apps now to do the lending as well. So banks are incredibly powerful in it. They have retail deposits to lend, but they also use the wholesale money market to lend their money as well. That's how they get their cash. So banks are there. You've also got challenger banks. We may have come across a few challenger banks. Metro is one example. Starling. These are new banks that have got their banking license and they're lending now a little bit to boost the marketplace. But you still got your biggies, your Barclays, your Lloyds, your HSBCs. These are the big lenders. You've also got building societies, of course. Let's squeeze them in there for you. Building societies. Now, building societies are a great institution. There you go. Mutual, so owned by their members. The biggest one, of course, is Nationwide, which is still a mutual. Upgraded their logo at the weekend. Very smart, Mr. Nationwide. Very fancy and modern. You forgot to put a capital N, though. There we go. But the building society has been lending for hundreds of years, and they continue to do so. The thing about building societies, though, is they do have a few restrictions on what they lend. And they can lend mostly their own retail money. They can do a 50% of their lending on wholesale. So they can go into the wholesale marketplace, but not for all their lending. They have to get most of their lending, or half their lending at least, from retail customers. But they've got plenty of customers with deposits, and they're not short of that at all, because it's a great place to invest your money. They also are restricted on where they can lend. They are restricted on commercial. So they are mostly residential lenders, building societies. So that's pretty much building societies, really. Who else have you got? Well, you've got your specialist lenders. So let's put those in over here. Specialist lenders. Now, I was at a conference last week in London for big intermediaries doing some speaking. In fact, really enjoyed that. And we had a number of specialist lenders doing their presentations at the front, telling all these brokers about their criteria. And the specialist lenders said, we're here for you, the intermediary. When the going gets tough, we'll always be there by your side. It was all very nice. But the point is made that the specialist lender has no branches or apps to sell directly to the customer. They don't do that. The specialist lender lends via intermediaries. every time, every single time. And that's the right thing as far as they're concerned. And they do specialist lending. So what they try and do is lending that the banks and building societies don't do. So the Nationwides and the the Lloyds and HSBCs do what we call high street lending, which is cheap and cheerful, really. They do bulk stuff. Whereas specialist lenders specialize in different areas. They might do second charge lending, for example, they might do bridging finance, they might do buy to let lending. There was a lender last week who do lending to people with a bit of a credit stain, a bit of a coffee stain on their credit report. So they don't do the mass stuff, they do the specialist stuff. That's your specialist lenders, who I think are brilliant. They get all their money from wholesale, the wholesale market. By the wholesale marketplace is it's just an enormous marketplace where you can go and borrow a lot of cash over a long period of time. That's how it works, pretty much. And specialist lenders, of course, don't have retail investors, so that's how they get their money. They get from that. Many will securitize. In other words, they've lent the money out, and once they've lent like a load of money, they will then package that up into a mortgage-backed security and sell it on to the marketplace. So that's how they generate more money to lend in the future. Banks, of course, do that. Don't get me wrong, and building societies do to a degree as well. The specialist lenders always do securitization, as they call it. Who else have you got in the mortgage market? A couple others then. Let's put a couple on here for you. You've still got this rearing its head, the peer-to-peer lender. Now, the peer-to-peer lender rose in popularity before the pandemic, really, when interest rates were low. And what the peer-to-peer lender does is it's a web company, pretty much. It has a web app. So they are a digital company, effectively. It's a proper company. And they take money from investors using the web app. So people invest money with them and earn an interest. And then they lend that money to people who want to borrow it. So they will lend it to people buying property. They also lend in the personal market as well. And that's their market. So they take lots of money from people, a bit like crowdsourcing in a way, isn't it? And then they lend that money long on mortgages or whatever type of finance they are involved in, because they're lending peer to peer. They don't have they're not a bank, effectively. They don't have branches, anything like that. They've lost their shine a bit, really. A couple of the biggies have gone bubbling under, but peer to peer lending was there as well for a little while to shake things up as well. Insurance companies, let's put those in there for you. Insurance companies have the ability to lend on mortgages, but they don't tend to do much of it these days. Insurance companies are not where they're at, really. That's not what they do. But they have the ability to lend as well. And not a lot of people know, but local authorities do too. The local authorities or local council also have the ability to lend, and they have done in the past, but not so much these days. It's not what they get involved in, isn't it? So that's pretty much where money comes from. There's little variations of each of these, of course there are, along the way. So of course these people then, or these institutions, need to lend money to the public, to the general public. And the public, of course, is served directly by the institution. The banks and building society will serve the public direct. But the public are served by specialist lenders via brokers. And we know that over here, I'll put the broker, the insurance broker, the mortgage brokers who we're really referring to here. She will broke the marketplace, there we are, and she will find the right lender from the different marketplace to suit her client. Now there's one or two institutions between her and the lenders which you need to be aware of course. The big one are networks, which we talk about in other videos. Now networks are firms that are authorized with the FCA, but the broker is connected to the network, usually a member or an appointed representative, and she deals with the network, and it's the network that does the deals with the lenders. See, lenders aren't just going to lend to anybody, any mortgage intermediary, any broker. You have to arrange an agency. So the network is big. They've got lots of these brokers, and they deal with these lenders, and that's why you get this thing called whole of market, because she's probably whole of market, able to access the entire marketplace. There's a few other things, just to finish off the story here. There are these things called mortgage clubs. You might have come across mortgage clubs. There you go. Which are rather lovely things, aren't they, mortgage clubs? Now, they're nothing to do with authorizing yourself through the FCA. The network, of course, will go directly to the Financial Conduct Authority for authorization. The broker gets that on that back of that. But the club has nothing to do with the FCA. But the club allows this broker, this lady here, to join the club. And then the club has done deals with lenders as well. Because they're big. I mean, the biggest one is Legal & General Mortgage Club, classically good firm, and they got thousands of broker members. And these broker members may be members of networks for their authorization, but for the club, they get better deals. You see, they might get a better deal from the Nationwide Building Society, for example, or from Pepper Home Loans over here, than they would have got from their network. So these lenders are dealing with networks and clubs as well. A couple others for you. You might have come across as packagers. Now, a packager, again, let's put that in there for you. A packager is a glorified broker, really, which the broker deals with because the packager packages up the case and for whichever lender they've got to deal with. So, for example, they might be dealing with a specialist lender, Pepper, whoever, Foundation, whoever, and they might. This lender said to the packager, "Look, if you package the case for us, do a lot of the work, we'll pay you a higher percentage of proc fee." So the broker deals with the packager, who then packages up the case, gets a better proc fee, keeps a bit themselves, of course, and passes it back on to the broker. So that's just another way of operating. I think there's probably too many middlemen going on there as well. And the last one, just to squeeze down here, and I love this phrase. Met one of these last week when I was on a conference called a master broker. Had this lady come up to me at the conference, and she worked for a master broking firm. I said, "Oh, so you're a master broker?" She did have a chuckle because it's a weird name. Now, what a master broker does is they deal in the seconds market, second charges, bridging finance, very specialist lending area. And because the seconds requires a lot more admin and postponing of first charges and all sorts of things, the master broker does all of that. So what would happen is the broker would deal with the master broker would deal with the specialist lender who's doing the second charge, so something like Castle or whatever, and they would get the commission, of course, but they would give most of the commission to the broker and they would keep a bit themselves. So there's an awful lot of middlemen in the middle in our sector, isn't it? I don't know whether that's going to carry on. It probably will go as technology improves. Technology will improve because what technology does, of course, is it wipes out the middleman, isn't it? That's the whole point. And of course, the banks are hoping they can get rid of all of this so they can lend directly to the public and keep all the profits. That's that's where that's where they're going. I mean, banks are shareholder-based companies. They have loyalty to their shareholders in dividends. They don't have loyalty to anybody else really at the end of the day. But they say they do. That's fine, and I get all of that. So that's the current lending sector as things are. Where will things change? Who knows? Who knows where things will change in the future? As you can appreciate, you've got a lot of people lending money. The banks will want to continue lending money. The building societies will want to continue lending money. Specialist lenders will want to continue lending money. There's always money to lend. There's demand for mortgages. There's customers who want to take a mortgage and do whatever they've got to do. And to do that, there's people giving the advice, of course. These people take the advice risk. In the future, I think the banks and the big building societies will focus directly with the clients, customers, using apps and technology, AI, and all those things will come into their own for pretty basic mortgages, high street lending. The broker will have a position in specialist lending, dealing with more complex cases, because that's what they do, seconds, etc. People don't understand those so much. The broker will be required for that. And the banks, building societies, the big ones anyway, will deal directly with customers using artificial intelligence. So you'll get advice. Of course you will. But you get advice from a bit of intelligent computer, artificial intelligence. It'll be on an app. It'll be called Artie or Arlie or Arby or something, some fancy little dinky name. And that's how it will evolve. It will. It's just the way it's going to be. It's an interesting synopsis for you of the UK lending sector. Bye. Well done. Well done. Hey, yeah, quite a bit of an update there for you on things in our session today. Just an update on the sectors and how things are. Next week, we'll finish off by taking a look at the lending market, how intermediaries and how mortgages are distributed more. We're going to talk about that more next week, but it's a bit of a synopsis, a bit of an update for you on that one. This week, what's going on? Well, we've got some few things happening this week, which will be of interest to you. We're starting a CMAP 2 podcast on Saturday morning. That's starting at the end of October. So you need to log on to our system for that. If you're not on our system, as always, do go there. There's the QR code for you, so you can get onto our membership database, as we call it. Bit of a fancy name, isn't it? But we'll give you free invitations to the CMAP2 podcast. We've got that coming up as well. A few exciting things going on in the marketplace. Mortgage marketplace is looking good, but the conferences this week, interest rate, what's going to happen in October, So things are looking slightly better, bit better sentiment in the marketplace, I think, as well. So I hope you've enjoyed the live stream. I have, as always, and I'll be seeing you all guys next week for you to enjoy yourselves as well. Enjoy yourself next week and all those good things as well. So other than that, it's a goodbye from me, and let's leave you these twirly little lovely little logos going on there. Oh, great stuff. See you next week. Bye.